A few weeks ago, Janet Yellen made an astonishing claim that runs contrary to any kind of economic theory alive today. And that is that she made the claim that the spending bills that would be passed by Congress, where government would borrow or tax money out of the private sector to spend on either investments or to boost consumption, would be anti-inflationary, meaning that it would actually lower the inflation rate over time. In other words, it would contribute to a drop in prices. And I'm sure that part of her reasoning here is that it would boost GDP by so much that the natural growth in GDP would drop prices over time because you get more goods produced, and with more goods produced versus the same amount of demand for those goods means that the price will come down because now there's more to buy with the same amount of money. However, this is absolutely antithetical to the school of thought that Janet Yellen comes from. And this tells me that what she is doing here is that she is becoming a political shill for the Democrats in Congress and President Biden. In other words, she is saying to the public what the Democrats want her to say and not what her economic training has taught her to say, because she is trying to advance a political agenda. She's lying to you to try to sell the stimulus bill, because if she came out and admitted that the stimulus bills that she support would increase inflation even further, even though it would bring on the promised increases in economic growth, it would not settle well with the public and the investment community. Now, before I continue, I've made a harsh claim on Janet Yellen, and I don't say this very easily about why I know that she's lying. So I'm going to provide you the proof in and of itself, and then I'll let you decide whether she's being deceitful or if she's telling the truth from her point of view. First off, let's learn a little bit about Janet Yellen. First off, Janet Yellen was the first woman to serve as the Secretary of Treasury in the United States. So she's the first appointed female Secretary of Treasury ever in our history, and this was put in under the Biden administration. But before that, and even more importantly, she had a long history of serving inside of the Federal Reserve. So she was very influential in monetary policy. She was the vice chairman of the Federal Reserve, while Ben Bernanke was chairman of the Federal Reserve during the 2008 and 2009 crisis. And she eventually succeeded Bernanke in 2014 to become the first woman to serve as chairwoman of the Federal Reserve Board. Now, as a policy advisor, and I want you to keep key on this, she is what they call a dove, meaning she believes in loose monetary and fiscal policy. So she believes in advancing strong stimulus spending, even if it's through borrowing or expansionary monetary policy through money printing to drive economic growth. She is a Keynesian economist who believes economic markets require government regulation. She values low unemployment over low inflation. Now keep a mind in there. So monetary policy knows that when they increase the money supply, even though it results in growth, it can increase inflation. She is someone who believes that the growth that comes from the economy through expansionary monetary policy will lower unemployment, and it will have a cost of inflation, and you might get higher inflation than normal, but basically you get more bang for your buck. The growth outpaces the cost. Now, that's one thing how you know that she's lying here, because she understands that there's a trade-off between any type of expansionary policy. Expansionary policy dictates that there will be higher inflation. You can't have both inside of the Keynesian model. If you get expansionary policies, you get higher inflation, but the advantage is that you get lower unemployment. And the gamble is that you get more lower unemployment, aka you get more growth in the economy than you do higher prices, which allows real growth and expansion of the economy, leading to an overall sustainable increase in the well-being of the people, at least in the short run. This is the Keynesian aggregate supply and aggregate demand curve. Now, it looks complicated, but I'm going to walk you through it. Keynesians believe that during times of economic crisis, real GDP represented on the horizontal axis is about right here, and that here at YN, from YK to YN, is this output gap. This is where potential GDP could become. And because the economy is not firing on all cylinders, so to say, it's the Keynesians' job to boost this curve, to boost what is called aggregate demand, the demand for goods, to boost the economy or boost real GDP up to this point. Now, Keynesians believe that up until this point, you can grow the economy with expansionary policies, but once you reach this point or dare go beyond it, what you will get is higher prices more than you will growth, and the economy will technically contract. Now, notice here that in the Keynesian model that any time you have an expansionary policy, so stimulus spendings, infrastructure bills, investments, government investments, it will boost aggregate demand according to the model and create growth, but the cost is that it will cause higher prices. So when Yellen says that the infrastructure spending bill will lower inflation over time, that runs counter to her model, because nowhere on this Keynesian graph does it ever show that an investment can lower inflation. And according to the Keynesian multiplier theory, that's what this whole thing is backing. It asserts that an increase in private consumption expenditure, so when Keynesians advocate a stimulus bill to hand paychecks to people to spend, or investment expenditures, which is what Janet Yellen is trying to argue that this infrastructure spending bill is, or net government spending, gross government spending minus government total tax revenues, it raises the total gross domestic product by more than the amount of the increase. So in other words, you get more boom in the economy, but the disadvantage is that you're spending more, okay? So going back to this model, you're booming the GDP more than you are increasing prices at any point in the early stages when there's a severe slump. In the long run, Keynesians acknowledge that, yeah, you could boost spending all that you want, but it's not going to cause much more growth in the economy. But because there's these underutilized resources, there's these materials and labor and all this capital that's just laying around from the last crash that's not being used by the business sector because businesses are too scared to grab a hold and use it. It's the government's job to fill in that gap temporarily and use those, even if it causes a higher price level because they're spending more money than what otherwise would have been spent. But the advantage is that you get the boom out of it. So how does Yellen justify her stance? Let's listen to her, and then I will give you my commentary.
Percentage point.
Will it drive up short-term inflation even more?
No, I don't think that these investments will drive up inflation at all. First of all, they're fully paid for. Not by imposing higher taxes on anyone earning under $400,000, but by asking corporations, high-income individuals to pay their fair share, and by investing in the Internal Revenue Service so that they can boost compliance, which is fallen to low levels. We have a huge amount of uncollected tax revenue, a tax gap that's estimated at $7 trillion over a decade. And the spending that's involved, it occurs slowly over the course of a decade. So unlike the American Rescue Plan, which was attempting to address the impact from the pandemic, right, and involved a lot of spending in a short time, the infrastructure and Build Back Better packages are spending that's really small relative to the economy in any year and spread over 10 years. And as I said, it will boost the economy's potential to grow, the economy's supply potential, which tends to push inflation down, not up. And you know, for many American families experiencing inflation, seeing the prices of gas and other things that they buy rise, what this package will do is lower some of the most important costs, what they pay for health care, for child care, and it's anti-inflationary in that sense as well.
So what she doesn't tell you is that she was saying that it would lower some of the cost by saying that it will lower health care and child care, but what she doesn't tell you is that the other spending that goes into it will drive up the cost everywhere else. Again, what she is saying here is that we can boost spending and it would increase aggregate supply, so this supply curve will shift out and that will drop prices. Now she's right that if aggregate supply did shift out, it would drop prices, because as you see here, as you push it to the right in the face of a demand model, it will drop that price level over time. But that's not what Keynesians are gambling here. What they are gambling is that they're trying to boost aggregate demand. That's what an increase in spending does. An increase in spending does not boost supply. An increase in spending boosts demand. What she's saying here is that an increase in investment won't boost demand, it'll boost supply. So by handing money over to businesses to invest that they otherwise would not use, that's going to drop prices, because what it will do is that those investments will yield products which will lower the price level over time. The problem is that what she's doing is having businesses spend more on existing materials to produce that final product. If they're spending more on those existing materials, then we go back to this aggregate demand curve and it drives up the prices of those materials, as we have seen in the producer price index. And it's one of the reasons why the producer price index is so high right now. The producer price index is so high not because there's all this available capital laying around ready to be used. It's so high because there's so little materials and resources available to use. Demand is not here on the curve. It's here. It's too high. And that's why we're getting more and more price increases with less and less growth if we were to follow this Keynesian model. That's what she's saying. Now, she tried to correct herself by saying, well, what we're doing here is that we're going to tax businesses. So remember, let's go back to this Keynesian multiplier. It asserts that an increase in private consumption, investment expenditures, or net government spending, which is gross government spending minus government tax revenue, will boost GDP, okay? So let's take that into account. She's not going to boost private consumption expenditures directly because she's doing an investment. So an investment in producing goods. Okay, sounds good. That sounds altruistic. She's not doing stimulus spending because she says it's going to be paid for with tax increases. So that marks out number 2. So is she boosting investment? Well, no, because she's not adding any more net money or available financial capital to the investment community. She's taxing the businesses to rotate money back into the business community. So now it becomes a tug of war. Who has the advantage of knowing what resources to use properly? Does the government know, or does the private sector know? It has been the testament of history for the last 100 years that the private sector always knows what to do with resources a whole lot better than government. We've seen what happens when government controls resource allocation. When government controls the food supply, it leads to shortages. Let's take a look at Venezuela, or Mao Zedong's China, or North Korea under the Kim dynasties, or Pol Pot in Cambodia. They always starved to death no matter how much the government tried to invest in it. Whenever government controls energy, it results in shortages. Go back to Venezuela on that one. When government decided to nationalize the oil industry, they were able to maintain profits for about 40 years, and then they taxed those profits and tried to spend on social welfare programs. They did not invest in expanding their production, and they did not invest in recapitalizing and replacing their fixed capital cost, which means that the production started to drop because those operations could not be continued, thanks to the fact that those machines failed and they did not replace those failing machines and machine parts, nor did they set up the supply lines and the supply chains to construct the materials to replace those parts. They just allowed the economy to erode. So the testament of history runs completely opposite of what Janet Yellen is saying. Even her own model disagrees with her on that respect. She's not really advocating Keynesian economics. She's advocating communist economics there. She's saying that the government can basically be a better manager of resources, and history has shown that that's completely opposite. Keynesians would be appalled by this and should be appalled by this because they would recognize that she's full of garbage saying this. The whole point of the Keynesian argument is that during a time of severe economic recession, such as 2008 or the Great Depression, there's these underused resources that the government can stimulate by getting the cycle of money to flow through stimulus spending. But that requires government borrowing. It does not require taxation. Keynesians admit that if the government taxed, then the advantages of the growth is completely removed, if not diminishes severely. But Yellen is basically talking out of both sides of her mouth. She's saying it's not going to be inflationary because we're going to tax the businesses. But if you're taxing the businesses, are you really adding any type of financial resources to the economy? No, you're just rearranging the deck chairs on the Titanic. And that's the point that I'm trying to make. I'm not a Keynesian by any means. I do not agree that the economy functions this way. And I might produce a video on why I disagree with it. But even if you do agree, even if you are a Keynesian or do agree that there's something the government can do during times of economic crisis, you have to admit what we're seeing right now with the higher prices, particularly on the producer price front, tells us that we're really around here on the demand curve. We've reached max potential GDP. More spending is not going to grow the economy. It's actually going to diminish the economy because it's going to drive up prices higher. Guys, thank you for watching this video. If you like the video and the content that I provide, make sure you like this channel, like the video, subscribe to my channel, and click that notification bell. Leave me any questions or comments below. Tell me what you think about all of this. If there's anything that's confusing about all of this, hit me up in the comments section. Shoot me a message in the inbox, and I'll try to get back to you as soon as possible and answer your questions. Once again, thank you for listening, and I'll talk to you later.